Welcome back to the Deep Dive. We're here to take your source material, unpack it, and really get you up to speed. Today, we're tackling something pretty fundamental for anyone investing, really. It's that big choice, value versus growth investing. And for you listening, this is more than just, stock categories. It's like two different ways of seeing the world, seeing how wealth gets built. Are you maybe more like a Warren Buffett type, patiently searching for those hidden gems, assets the market just doesn't appreciate right now? That's value. Or are you aiming for the next big thing, the disruptor? Chasing, the potential of the next Amazon, the next Tesla. That's growth. We've got some great sources lined up here to really break down let's say, the DNA of both approaches. We want to go beyond just the simple definitions. We'll dig into the trade-offs, the kind of mindset you need for each, hopefully help you figure out where you and your money might fit best. So let's dive in.
Yeah, that's a great way to frame it, because these aren't just, tactics you try out for a week. They're philosophies. They really hinge on whether you fundamentally believe the market is, well, mostly rational, or if it's driven more by emotion, by sentiment.
Okay, so let's start with maybe the classic approach first. Value investing. At its core, it seems to be about finding inefficiencies, right? Believing the market messes up sometimes.
Precisely. It's the belief that the market gets emotional, swings too far, and creates opportunities. Value investing simply means buying a stock for less than what it's actually worth. You know the classic analogy. It's like finding a $100 bill lying on the street, but you only have to pay, say, $70 to pick it up. That $30 difference, that gap between the price you pay and the real underlying or intrinsic value, that's what value investors call the margin of safety.
Margin of safety. So it's like built-in protection.
Exactly. You're essentially buying yourself some insurance against things going wrong, or just against market volatility because you bought it cheap to begin with.
Right. But here's the tricky part, isn't it? How do you actually figure out that intrinsic value? It can't just be a gut feeling. How do value investors put a number on it?
Oh, absolutely. It's not guesswork. They definitely use quantitative tools, hard numbers. But the real expertise, I'd argue, is knowing the limits of those tools. So yes, they look at things like the price to earnings ratio, the PE ratio. They look at the price to book ratio, PB. And often they'll check for a decent, reliable dividend yield.
PE and PB, those are the classics.
They are, but think about how they've evolved. PE tells you how much you're paying for each dollar of the company's current profit. Still very relevant. The PD compares the stock price to the company's net assets, the stuff on its balance sheet. Decades ago, for, say, an industrial company, that was huge. Tangible assets.
Yeah, factories, equipment.
Right. But today, if you're looking at a software company or a service firm, their most valuable assets might be, well, intangible, code, brand recognition, intellectual property. PB suddenly looks less useful, sometimes almost meaningless.
Ah, okay. So the tools haven't necessarily kept up with the economy.
Or rather, the investor needs to adapt how they use the tools. A good value investor today might need to do some serious digging, maybe forensic accounting, to really understand and prove the value, especially if it's not just physical stuff.
That makes sense. It's about context, not just the number itself. And our sources seem to suggest the best hunting ground for value investors is often when everyone else is panicking.
Oh, absolutely. Peak fear is often peak opportunity for them. The chance arises not usually because the company itself is broken, but because the market is scared. Think about a big market crash. Suddenly, solid, established companies, maybe Coca-Cola, Johnson & Johnson, they get dragged down with everything else. They start trading at a discount simply because of broad fear, everyone rushing for the exits.
And the value investor steps in then.
The value investor steps in and says, wait a minute. This company has decades of reliable earnings, a strong balance sheet. I trust the fundamentals, not the panic. They buy when others are selling fearfully.
Which brings us back to that famous quote, doesn't it? Price is what you pay, value is what you get. You need discipline to ignore the noise.
Tremendous discipline. And patience. You're focused on the business reality, the underlying value, not the stock ticker's daily drama.
Okay, so if value investing is about finding today's bargain based on current reality, then growth investing must be the flip side of that coin.
Completely. Growth investing isn't really looking at today's price tag, or at least not in the same way. It's all about the future. The focus is entirely on companies that are showing or are strongly expected to show really rapid, above average growth in their earnings, their revenues, their market share.
So it might look expensive now.
Often, yes. Based on traditional metrics like PE, a growth stock can look incredibly expensive. Maybe it has a PE of 50 or 100, or sometimes it doesn't even have positive earnings yet. But the growth investor says, that's okay. They justify that high price today because they believe the company is going to grow so fast, so exponentially, that today's price will actually look cheap compared to where the company will be in 5 or 10 years.
So it's a bet on execution, on future dominance.
Exactly. It's a bet on innovation, on management's ability to scale rapidly, on capturing a huge market. You need strong conviction in that future story.
Okay, so if a value investor uses PE to say, see, it's cheap, the growth investor sees a huge PE and says, yeah, but my forecast shows 50% annual growth for the next decade, so it's worth it.
Precisely. They're modeling out that future growth curve. And this difference leads to a really fundamental split in how these companies handle their cash,
Right.
especially when it comes to dividends.
Oh, right, dividends.
Think about it. A dividend is basically the company saying, we've looked around, and honestly, we don't have a better way to use this profit internally to grow faster, so we're giving it back to you, the shareholder.
Which sounds like something a mature, stable company would do. A value company.
Often, yes. Value stocks frequently pay dividends. But growth companies, they see every single dollar of profit, and often they borrow even more as absolutely critical fuel for the growth engine. They pour everything back into research and development, into marketing, building new factories, hiring salespeople. Whatever it takes to expand as quickly as possible, growth is the priority, not returning cash now.
So it's a completely different philosophy on capital. Return it versus reinvest it aggressively.
Absolutely.
And this explains why when you think of classic growth stocks in their, high growth phases, you think of companies like Amazon or Tesla or Netflix back in the day.
Exactly.
Nobody was buying them for their low PE ratios or their steady dividends. You were buying them because you believed they were going to fundamentally reshape or even own their industries. It was a bet on disruption.
A bet on the vision, on innovation, on the management team pulling it off, often despite what the current financials look like on paper.
Okay, so we've painted pictures of the two poles here. Value, growth. Now let's get practical. For you listening, understanding the actual trade-offs is crucial, right? It shapes your whole investment process.
Yeah, let's break down what each strategy really asks of you, the investor. We can sort of compare them side by side. Okay, valuation first. Value stocks, by definition, look cheap on current metrics. Growth stocks often look expensive.
Right, dividends.
Value stocks often pay them. Growth stocks usually don't. They reinvest.
What about risk? This feels important.
Very. Generally speaking, value stocks are considered more stable, maybe less volatile. You have that margin of safety cushion. Growth stocks are inherently riskier, much more volatile. Big swings up and down are normal.
But with that higher risk comes
higher potential upside. Exponential returns if you pick the right one and it succeeds.
and the time horizon. How long do you need to wait?
Well, both require patience, but maybe in different ways. Value investing often needs patience for the market to recognize the value you saw. It could take years for the price to catch up to the fundamentals.
So the stock might just sit there for a while.
It might feel like dead money sometimes, you know.
Okay.
You need the discipline to hold on while you wait for that validation.
And growth?
Growth investing needs patience through the volatility. You have to be willing to stomach those big drops, sometimes 50% or more, and hold on based on your belief in the long-term story. It's about riding out the storm.
That's a really interesting distinction. Both need patience, but for different reasons. One is waiting for the market, the other is enduring the market.
Well put. And the kind of research needed is different too.
How so?
With value, you're often analyzing things that exist now. Balance sheets, cash flows, debt levels, physical assets. It's more concrete, maybe more accounting focused.
Okay.
With growth, you're analyzing potential, things that haven't happened yet. Market adoption curves, technological advantages, competitive responses, management's vision. It requires more forecasting, maybe more domain expertise in that specific industry or technology.
You really have to believe in the story for growth.
You do. You have to understand why this company can keep growing so fast.
Let's talk pros and cons then, more directly. Why pick one over the other? What are the real benefits and drawbacks?
Okay, let's start with value. The pros. Generally safer, steadier returns over the long haul. That margin of safety provides downside protection. It's often seen as ideal for capital preservation and steady, long-term wealth building. Less stressful, maybe?
Sounds sensible. What's the catch?
The catch is, well, it can be slow. You might miss out on those explosive returns that growth stocks can deliver. And as we said, you might have long periods where your value stocks underperform the broader market, especially during, say, a tech boom when sentiment is sky high. It requires patience.
Okay, now growth. The benefits.
The big one is potential. the chance for truly massive market-beating returns if you catch a winner early. It's exciting, driven by innovation and disruption. You could potentially multiply your initial investment many times over.
The downside feels pretty obvious, though.
It is. High volatility is the norm. It's much, much riskier. For every Amazon or Tesla, there are countless other high-growth hopefuls that burn bright and then flamed out, taking investor money with them.
Survivorship bias, right. We remember the winners.
Exactly. Picking the long-term winners in advance is incredibly difficult. You're betting on an uncertain future, and many bets won't pay off. It can be gut-wrenching to watch your investment drop significantly.
And we should probably mention taxes, too, briefly. That plays a role, doesn't it?
It does. It's a practical consideration. Value stocks, especially dividend payers, often generate income along the way, which gets taxed annually.
Right.
Growth stocks typically don't pay dividends. Your return comes purely from the stock price going up, capital appreciation. You generally only pay taxes on that gain when you eventually sell the stock.
So you can defer taxes, potentially for many years, letting the investment compound more effectively before the tax hit.
Correct. If you hold a growth stock for more than a year, you usually qualify for lower long-term capital gains tax rates too, compared to the ordinary income tax rates that often apply to dividends. So that long-term patience with growth stocks can come with a tax advantage.
Okay, so bringing this all together for you listening, it sounds like there's really no single right answer here. Value or growth?
Absolutely not. There's no one-size-fits-all. It genuinely boils down to you. Your personal risk tolerance, how much volatility can you actually stomach, your time horizon, how long until you need this money, and your financial goals.
So if you prioritize protecting your capital, if big drops keep you up at night, maybe value provides that anchor, that stability.
Generally, yes. It's often better suited for lower risk tolerance or shorter time horizons.
But if you're comfortable with risk, you have a long time horizon, and you really believe in the power of innovation to drive huge returns, then growth offers that potential engine.
That's the trade-off. Higher potential returns usually come with higher risk and volatility.
But, thinking about truly successful investors over the long run, do they really pick just one camp and stick to it exclusively?
That's a great point. And honestly, many of the most successful investors find a way to blend the two strategies. It's not always strictly either.
So combining them, like a diversified approach within your own portfolio.
Exactly. Many people build a portfolio with maybe a core holding of more stable, perhaps dividend-paying, value-oriented companies. This provides a foundation, some stability, maybe some income.
Kind of like the bedrock.
Precisely. And then around that core, they might add satellite positions, smaller allocations to specific high-conviction growth stocks. These offer the potential for that extra performance, that market-beating upside.
That makes a lot of sense. You get the balance. The stability and capital preservation from value, plus the potential kick from growth.
It helps mitigate the risks. You smooth out the ride a bit, you're less likely to experience the extreme volatility of a pure growth portfolio, but you're also not potentially stuck in the slow lane like a pure value portfolio might be during certain market phases. It's about finding that balance that works for you.
A balanced approach for the long term.
Okay. And that sort of leads us to a final thought for you to chew on.
Okay.
We've talked about how growth strategies depend on handling volatility right. And value strategies rely on patience, waiting for the market to correct itself. So here's the question. If you're using that blended portfolio we just discussed, how might focusing on the economic cycle itself influence how well that blend performs in the short term?
You mean like when the market is super optimistic versus when it's really pessimistic?
Exactly. How does market sentiment, that broad optimism or pessimism, interact with the portfolio that's trying to balance stability and patience, value, with volatility and future potential, growth? Does one side benefit more in certain cycles? How does that interplay work out?
Interesting. So thinking about the market's mood versus the underlying company fundamentals and how that affects a blended strategy, definitely something to consider as you think about allocating your capital. Great stuff. Thanks for breaking that all down. And thanks to you for joining us on the Deep Talk. We'll see you next time.